We're conditioned to look for wealth in the noise of a high-tech trading floor or the latest cryptocurrency surge. But a far larger movement of capital is happening inside the quiet neighborhoods of Middle America. Economists call it the Great Wealth Transfer, a 20-year window where trillions of dollars will shift from the baby boomer generation to their heirs. This isn't a phenomenon limited to billionaires or the ultra-elite. It involves millions of families who are currently preparing to pass on their homes and life savings. The sheer volume of these assets moving at once creates a massive pressure on the financial system, shifting how the country invests, how it spends, and how it saves. To see how we got here, we have to look at the last 40 years. A specific set of economic conditions allowed the older generation to accumulate a record-breaking share of household capital. This reservoir of wealth is concentrated in three primary areas: early home equity, a multi-decade stock market climb, and the steady growth of structured retirement accounts. But as the boomer generation reaches retirement age, this massive stationary pool of assets is being forced into motion. Moving a lifetime of accumulated value across generations is a fragile process. If the handoff is mishandled, that wealth can disappear long before it reaches the next generation. Wealth rarely travels in a direct line. It's dispersed through a legal maze involving grandchildren, specific family trusts, and charitable organizations. Think of this as a transfer pipeline. Every accumulated dollar must pass through legal and financial valves. High tolls, estate expenses, probate, and taxes act as significant leaks. Without investment knowledge, the flow slows to a trickle. In this high-stakes gauntlet, family fortunes are routinely lost. Beyond the legal hurdles, the greatest threat to this capital is behavioral, the specific psychology of sudden wealth. Historians have long tracked the three-generation rule, where inherited fortunes are almost entirely exhausted by the time they reach the third generation. The combination of a lack of financial education and the natural urge to overspend can drain an inherited portfolio faster than it can be replenished. This is why sectors like financial planning and digital estate management are currently seeing a massive surge in demand. They are the modern countermeasures to that drainage. Ultimately, the success of this transfer depends on whether the heirs have the literacy required to manage what they're given. When the surviving capital finally reaches Millennial and Gen Z heirs, it begins to behave differently. Younger generations are moving away from the static holding patterns of their parents. They are using these funds to pay off debt, launch new businesses, and they are demanding low-fee, mobile-first investing tools. Traditional financial institutions are now scrambling to overhaul their technology to retain these new digital-first clients who have little interest in legacy banking models. This shift is forcing the entire consumer finance industry to change its infrastructure to match the preferences of the new owners. Even for those who won't inherit a dollar, this transfer will define the broader economic environment. As heirs deploy this capital, it creates a domino effect, inflating housing markets, increasing national entrepreneurship rates, and altering consumer spending across the country. This is a 20-year re-anchoring of the capital base that underpins the U.S. economy, moving quietly beneath the surface of daily news cycles. Innovation and income will always be vital, but the trajectory of American prosperity now rests on how wisely this inherited wealth is managed and passed down.